Travis, today we're going to dig into the latest U.S. jobs report. That sounds super exciting, but there is some really good information.
Yeah.
And so let's just say the numbers weren't really what the markets were hoping for. Payroll growth came in well below expectations, and right away Wall Street's buzzing about the Federal Reserve.
It's always about the Federal Reserve.
What they're expected to do. Some analysts are even betting on now a 50 basis point rate cut for the next meeting.
I was waiting for someone to float that. Someone couldn't wait to just float that one out there. But so job creation obviously did slow, Steve. Unemployment ticked up slightly, but labor participation held steady. So on the surface, it's not a collapse here, but it does confirm that we have a cooling labor market, right, which the Fed watches. So fewer job means slower wage growth, which could ease inflationary pressures. The idea is less money in the consumer's pocket, less demand for goods, easing pressure on prices there. But that puts the Fed in the hot seat now. Do they hold, or do they cut, or do they cut big? Is what markets are looking at.
Yeah, Travis. Treasury yields dropped almost instantly after this report. Equity markets bounced, especially in sectors sensitive to rates, which is real estate, tech, and consumer discretionary.
Yeah, but there's a split narrative here, Steve. I mean, some investors see this as a start of a downturn.
Yeah.
While others, Morgan Stanley among them, with a really, hot take here, are saying, wait, this could actually be the sign that the recession is over. It's not the beginning. So
it's aggressive.
Yeah, it's a hot take. Yeah.
So slowing jobs don't always mean an economic collapse. Sometimes it's just the economy balancing itself out after a period of just some overheating. Isn't that right?
Yeah. Yeah, I mean, that's right. I mean, for advisors and investors, the main message here is all about positioning portfolios carefully, specific to whatever your situation is, which you should always do anyway.
For sure.
We're always going to have this kind of noise happening in the background, right?
Yep.
So we're seeing a renewed appetite for defensive sectors. Think healthcare, utilities, even, consumer staples, areas that provide stability when growth is uneven. People like to stretch for growth, and becomes, when it becomes a little shaky, everyone goes back to those sectors that are stable, right? Yeah. And while equities get the headlines, they always get the headlines because they're, they seem more fun.
They're sexy.
Yeah, they move around more. The bond market is quietly telling its own story, like it always does. If you're smart, you listen to the bond market more than you do the equity market. So the U.S. Treasury just rolled out, what was it, a record-setting? I think it was $100 billion in short-term T-bills.
Yeah.
And investors snapped them up.
Yeah.
So that kind of demand shows confidence for now in the U.S., especially with expectations of a Fed cut on the horizon.
That's true. And if rates do come down, the government's strategy of leaning on these short maturities looks pretty savvy. Cheaper financing in the near term, but there is a trade-off, isn't there, Travis? There's heavy reliance on the short-term debt, means that you have to refinance that frequently. And if demand for those bills weaken, or yields move in the wrong direction, the rollover risk could put a real strain on our system. Isn't that right?
Yeah, I mean, if those rates aren't attractive anymore, we might have to issue longer dated paper to get people to buy it at, and be locked into those higher rates for longer.
That's right. So what's next, Travis? We'll be watching the upcoming inflation data, consumer sentiment numbers. Those could steal the deal on whether or not the Fed feels actually confident enough to cut rates by a little or a lot.
Yeah,
that 75 basis points you mentioned.
Seeing if they're going to fast forward here it's hard to imagine. It's not impossible. It's improbable though. But Bottom line here, Steve, weak job report doesn't spell doom. It's just a reminder that markets, policy, and Main Street are all intertwined. They always are, and the Fed is walking a fine line here between caution and action. During this cutting cycle, but even during the hiking cycle, it's the same thing. They're always walking that fine line.
It's so true, Travis. It's been great. I look forward to it next week.
Look forward to it as well.